down, right? What is the okay, the company's required rate of return is 15%. Would the company want the manager of the Raymond Evin division to make an additional investment of 100,000 that would generate 18,000? So what is the formula for residual income? Actual income. So actual income will increase by 18,000 minus how much they are required. Their requirement is 15% on 100,000, which is 15,000. So they are having residual income. Answer is yes. So that is the biggest conflict between ROI and residual income. If we base this example on ROI, the manager will reject. But if we base this example on residual income, the manager will accept. Right? There we go. So now combine this effect, that is the Redmond Evening division of wrap up. The corporation has net operating income 60,000, average operating assets are 30,000. They are required to maintain 15%. So what is the residual income? So can you calculate the residual income? Calculate that. So pause the video, those who are watching online, and calculate that. So right, their income is 60,000, they have earned it. Their requirement was 15% on 300,000 average operating assets. So residual income going to be 60,000 minus 45,000. Answer is C, 15,000. So Subhan, you understand? Junpyo, you understand?
Yes, sir.
Okay, good. So now, if the manager of the evening division is evaluated based on residual income, so they will be accepting this. We just saw that. Yes. Why? Because they are required to earn 15%, which is 15,000, and they are earning 18,000. So yes, they will be accepting this challenge based on residual income. Now, divisional comparison. So do we have a major drawback in the residual income? Like we have drawback in our ROI analysis? Yes, we do have. And that is divisional comparison. So the residual income has one major drawback, that is it cannot be used to compute performance of division with different sizes. And that makes sense because you can compare apple to apple. You cannot compare 1,000 with 10,000 or 100,000. You cannot compare, right? So example is here. So we have a retail department, we have a wholesale department. So their operating assets are 100,000, wholesale department assets are 1 million. So their minimum requirement is that they need to earn 20%. So both fulfill the requirement and earn 20%. Right? Here we go. So sorry. So that is their minimum requirement. So they are required to earn, retail department, they are required to earn 20,000. Wholesale department, they are required to earn 200,000. So which one is easy and which one is difficult to make? earning from 100 to making this 100 to 110 is easy rather than from 1 million to 1.1 million. Which one is more difficult? A option or B option? Of course, B option is very difficult, right? Both are earning 10%. So this is the illusion of numbers. So if the amount is small, percentage is bigger, right? So making 10% from $100 is easy than making 10% on $1 million, right? Same concept apply here. So the actual income is that the retail department, they earn 30,000, and wholesaler department, they earn 220,000. So their requirement was that they have earned residual income 20,000 and they have earned residual income 10,000. Now, which one is good? Wholesaler or retailer? If we base our analysis based on ROI, so you see here, the residual income, sorry, the ROI of the retail department is 30%. 30,000 divided by average operating assets. While the ROI of wholesale department is 220,000 divided by 1 million, 22%. So if we compare based on ROI, we would say that we would say that the wholesale department did bad because 22% is the ROI. But if we base on our residual income stuff, so we would say that wholesale department is earning 20,000 residual income while the retail department earned 10,000. But look at the magnitude. The wholesale department earned 220,000 while the retail store earned 30,000. So because of the size, 100,000 and 1 million thousand, the residual income we cannot compare. So can we say that the retail earning department did bad or wholesale department did bad? No. Why? Because both are earning residual income, positive residual income, 10,000 and 20,000. So can we say 10,000 is good or 20,000 is good or bad? We cannot. Why? Because we cannot compare. Because we cannot compare retail department to wholesale department because of the size. Both are earning positive residual income, but we cannot compare. Similarly, if we compare based on ROI purposes, even then we are wrong because earning 200,000 is more difficult than earning 30,000, right? So which method is the best one? Residual income is best one. Why? But residual income we cannot compare with different sizes. If the size is bigger, so you remember that we need to compare apple to apple, rather banana to apple, rather orange to apple. So if comparison is that sizes are same, prefer residual income. Now, our third learning objective is compute delivery cycle time, throughput time, manufacturing time. So this is the performance measurement in manufacturing department. So whether you have manufactured this good on efficient basis or not. So we have here. So when a company receives the order, it can be divided into, its delivery time cycle is divided into wait time. So when you receive the order, so it is on a pipeline. And then processing start, right? Production started. So we have process time. When the goods are processed, then it is inspected, moving out from the production department to warehouse, and then queuing for delivery purposes, and then goods are shipped. Those who receive, if the company receive early order, so they will send first that order. Queuing, we call this queuing. We are ordering, rearranging according to order. So all this stuff, wait time plus process time plus inspection time plus move time plus queue time, we call this delivery time, delivery cycle time. And process time, inspection time, move time, queue time, this is called throughput time or manufacturing time, right? So now you want to see that if you are completing the production in 11 days and your biggest time wasted here are like 8 days are here. So it means you need to improve here on wait time because your production is just and delivery is just in 3 days, right? So you can devise a plan to see that. So here we go. We have the example. So we have manufacturing cycle efficiency. The formula is value added time, which is process time here, which takes the most time. Converting raw material into finished goods is called value added time. The most time is spent here. Inspection, moving time, and queue time takes smaller time. So most time is applicable here. Divided by manufacturing cycle time, we also call it throughput time, right? So if you divide that, we call this machine cycle efficiency. So let's see the example here, then you will be understanding that one. So what is this machine cycle time or throughput time? So excluding all the wait time, move time, plus inspection, plus queue, plus process, we call this throughput time here. You see here, process time, inspection time, move time, queue time. So process time, 0.2 days, inspection time, 0.4 days, 0.6, move time, 5, 1.1, it means 10.4. Answer is number 1, A part. So guys, you understand what's going on here? Coco, Junpyo, Subhan, understand?
Yes.